I think the video that I'm going to make next regarding risk reward is one of the most important videos I can make. I would like to spend some time on this and make sure that you understand this. I know some of the examples will be quite tedious that I'm going to use, but I think it's such an important subject that you understand risk reward and compounding that goes with it very, very well before you start your trading career. Because trading is all about risk to reward. Now, what is risk reward? Risk reward means how well are you compensated for the risk you assumed. So what it says in fact is how much money will you make for the amount of money that you have risked. We always aim to make more when we are right than what we will lose when we are wrong. That is just the principle in the market. Now, risk reward is the thing that will make you rich. Not big moves, not hit rates. Risk reward. Risk reward is the main thing in the market. If you can understand risk reward, you can win this game. So for every $1 you risk in the market, you would like to make $2 or more. So that'll be a risk reward of 1 to 2. You risk $1 to make $2. So when you're wrong, you're going to lose $1. When you correct with the trade, you're going to make $2. Now I know that's theory. I'm just trying to bring across a point. That's all. So some of the stuff I will be saying, you must understand, is just theory. In practice, it doesn't exactly work like that because of reasons I'm not going to go into now at this moment. But for every $1 you risk, we aim to make 2 or more. Now, as I said, that is a risk reward of 1 to 2. Let's say we have 10 trades and we're looking at a 50% hit rate, and you risk $1 on every trade. So you're going to take this 10 trades and you're going to risk on each trade, your risk will be $1. And we're going to try to make a $2 profit on every trade. So how will this play out? So let's say you've got a 50% hit rate. Hit rate, remember now, is how many times you will be correct, how many times you will have a winning trade. So 50% hit rate means that 5 of your trades will be winners and 5 of your trades will be losers. Now, if I take 5 losing trades and I times that by $1, that means you will be losing $5 between the 5 losing trades. But if I then take the 5 winning trades where you will make $2 each, that means you will make $10 on the 5 winning trades. The net result, you will make $5 net profit. I don't like to work in dollars. I don't like to work in a monetary system. I like to work in percentage. Let's take that exact same example and let's put percentage in place of the dollar. So if we've got a risk reward of 1 to 2, we can just say we will have a risk reward of 1% to 2%. So if I take the same 10 trades with a 50% hit rate, that means my risk is 5 times, not $1, but 1%. That means my risk on the 5 losers are 5% of my portfolio size. Then my 5 winners is not 5 times $2, but 5 times 2% of my portfolio size, which will be 10%. So if we do that math, we're going to have 5 losers, which will lose us 5% of our portfolio value, but our 5 winning trades will gain us 10% of our portfolio value, which means a net result of 5% portfolio growth. So rather think percentages than dollars. Dollars is always, it's a monetary value, and monetary value makes us emotional. Percentages seems harmless in certain sense. I know we're human beings, we will look at the dollar values, but it takes a lot of the emotions out of the planning and out of the trading if we think percentages. Remember, we always think next 1,000 trades. So you must also think percentages from here on and not monetary value like dollars or rands or whatever your currency is. Every losing trade will decrease your portfolio with 1% of your portfolio value. And every winning trade will increase your portfolio with 2% of your portfolio value. So let's say you've got a $1,000 account and you risk 1% to make 2%. That means on the $1,000 you'll be risking $10 when you are wrong, and you will gain 1 to 2, you'll gain 2% of your portfolio, which is $20 when you are right. You can see it's the same thing, it's just a different way of thinking, that's all. So if you then take 100 trades at a 50% hit rate and a 1 to 2 risk reward, it means you'll have 50 bad trades and 50 good trades. 50 bad trades will mean 50 losses of 1%. 50 good trades will mean 50 profits of 2% gain. That'll give you a 50% portfolio growth. And another thing that's very important for risk reward is that you cannot expect a big one every time you go into the market. It's like playing cricket. You don't walk out on the pitch there and say, you know what, I'm going to hit sixes of boundaries off every ball. You're going to lose your wicket cheaply. So you walk out there and you're going to face each ball individually. When there's a ball that gives you a 6 or a 4 or any boundary, you will be making good runs. But otherwise, you play the dot balls and you play the 1s and the 2s to keep the scoreboard ticking until you get that ball that you can hit in the sweet spot and hit a beautiful boundary. But you cannot walk out on the pitch to hit a boundary on every single ball. You're going to lose your wicket cheaply, and that's exactly the same thing that's going to happen in the markets. Now you get the other mindset where people come out and say, as long as I can get ones, I'll be happy. No, we also don't want to just hit ones. That's little bit profit here, a little bit profit there. You don't even take the opportunity of a boundary if it's there, because you are just after the 1 or the 2 maybe. So it's important to go and play a well-balanced game. Walk out on the pitch and face every ball individually. Walk out in the markets and face every trade individually and trade every trade on its own merit. And also remember, you won't catch every big trade in the market. You won't catch every big move. You won't catch everything. You will just catch a few of those ones which set up very well. There's too many people that wants to chase in the market because they see a certain market starts to run. Their strategy didn't give them an entry, and now they chase after the market, stuffing up your risk reward and your hit rates completely. So if your strategy didn't give you an entry, don't chase. Don't go and stuff up your risk rewards. Chasing into the market gives you abnormal size stop losses, and your risk is way too big. That means your reward needs to be so big to really have a good risk reward. It's not worth it. Wait patiently and calmly for the correct trade to set up. Plan your trading according to your risk reward principles and try to lose 1% when you're wrong and make 2% approximately when you are correct. You're basically going to search for high probability trades in the direction of a well-defined trend. That's basically what it is. Guys, if you can have a 50% hit rate, you can win this game. So you don't have to have this 80 and 90% winning rates and hit rates and stuff like that to earn a solid income on the market. All you need to do is to take well-defined trades in the direction of a well-defined trend or according to your strategy, and have a healthy risk reward of approximately a 1% risk and trying to make roughly 2% on each trade. So with that, you can win the game if you have a 50% hit rate. Now I'm going to go through a little bit of a very tedious example. Now this example is, I know it's very tedious, but a lot of people don't understand this. I came across this so many times during my mentoring periods and coaching people and helping people to trade. They don't understand the real power of risk reward, adding to that the compounding mindset. Because if you can compound your account and you can work with a healthy risk reward, it's like printing money. It's not very difficult. So let's take this example that I've got here. I've got a $10,000 account and I've rounded down everything to make it easy. And I'm going to try to do it as quickly as possible, but I need you to understand this thoroughly. We're going to risk 1%. You can see here $100, and our profit we're going to aim to make a 2%, which is on the first trade, obviously $200. So 1% of a $10,000 is $100, and 2% is $200. Now let's say we got a winning trade. That means our profit is plus $200. So our account balance moved from $10,000 to $10,200, which is a 2% portfolio gain. Now I'm going to carry forward this $10,200 to the starter balance. Now this original balance doesn't count anymore. Now this is your balance. So your $10,200 account, your risk will be 1%, which is $102. And then your potential profits on a 1 to 2 risk reward is $204. So we got another winning trade, and we end up with a $204 profit. Add that to the 10,200 here, and that ends up to be a $10,404. Now I move that account balance to the beginning. Now you ignore any previous balances and you calculate everything from the new balance. So you're going to risk 1%, which is $104 on a $10,404 account, and your potential profit would be 2% of that. It's twice that. It's a 1 to 2 risk reward, so it is $208. Now we've got a losing trade. So it's a losing trade. We're going to lose what we've risked. It's 1% of that. It's the $104. So we minus $104, and then our account goes down to $10,300. Now I'm moving the 10,300 to the first column, and I'm going to risk 1% of that, which is $103. 2% of that is $206 for a potential 2% profit. Unfortunately, another failing trade, and we're losing $103 that we've risked. And that brings our balance down to $10,197. Carry that forward. So now I'm going to risk around $102, which is 1%. I'm trying to gain 2% at $204. So this is a winning trade, and this adds now $204 to our balance of $10,197, which leaves us with a $10,401, which is a 2% gain again. Now I carry this 10,400 to the startup column. Now what I want you to see is that as long as, this is where the power of compounding comes in, as long as we're making profit, you see the risk is getting bigger and bigger, and the moment we're taking a loss, we're risking less and less. That's what makes the percentage risk so powerful. That's what we're after. And the moment we start to make money again, the account balance grow, we risk more. And as the account balance become less because of losing trades, we risk less. So is the profits. The potential profit as the account grows become bigger, compounding, and the moment the account balance gets smaller, we see that the potential profit is smaller and smaller again. So you must keep this in the back of your mind, that you will always take bigger trades dollar-wise, but you're still risking 1% of your portfolio. You will still try to gain 2% of your portfolio, which is a higher dollar amount. Okay, you will risk a higher dollar amount, but it's still just 2% profit, and it's still just 1% risk. So we keep going with this. We've got, you can see here, another 1% risk and another 1% risk with a couple of losers and winners, and we take this right through to the end, and with a 6 out of 10 hit rate, meaning we had 6 winners and 4 losing trades. I did all the maths here. We ended up with $10,818 in the account. We started with a 10,000. We ended up with 10,818. That is an 8.18% gain after 10 trades, having a 60% hit rate. So this mindset is very, very, very important. Pause the video and work through these values one by one to make sure that you understand this 100%, because this whole mindset of risk reward, risking 1%, trying to make 2%, and using compounding, that is a winning principle as you become a trader.